We're back with Dr. Paul Kaplan, Morningstar Canada's Director of Research, who recently co-authored a paper that introduced a new concept in wealth management called gamma. Now, Paul, in a previous video, we outlined what the concept of gamma is about, which is a way in which investors can add value by making sound financial planning decisions. And in that video, you mentioned 5 factors, and I'd like to go back to that and expand a little bit on those 5 factors and give some real-life examples on how investors can add value by making sound decisions in those areas. Now, let's start with the first one, which is total wealth allocation.
Yes, the idea here is that your portfolio does not only include your financial assets, but also includes what we call your human capital. And the way to think about your human capital is, let's suppose you're young, you're just starting your career. Your career that's ahead of you is going to be generating income. And that stream of income, you can think of it like a bond. It's a stream of income that's going to get paid. And therefore, when you're starting off in your career, it's as if you had quite a bit of fixed income. And your financial portfolio, which for most of us would start off small, then we hope to grow it over time, therefore can be more heavily in equities. And so what we can do is, over time, we can balance our total portfolio, which consists of both our financial wealth and our human capital, in such a way as to maintain an overall level of equity exposure or overall asset allocation that we feel comfortable with from a total risk perspective.
Now, the second factor is dynamic withdrawal strategy.
Yes. A lot of times financial planning discussions, when it comes talking about retirement, starts off with a discussion that says, well, you have, let's say, $1 million you're retiring with. How much should you plan on spending? Oh, let's spend 4% of that a year. So let's spend $40,000 year in and year out regardless. And the idea here is that let's do something more sensible than that. Let's dynamically change the amount that we're withdrawing based upon our circumstances as the years go by. So a good example of that is the market. So maybe you were planning on doing a major vacation at the beginning of retirement, and then the market crashes. Don't take the vacation. Be sensible about it. Or maybe the opposite happens. There's an unusually, the market is unusually generous. And so you might say, you know what, I'm going to cash in on that and celebrate and take some additional traveling that I wouldn't do otherwise. So by sensibly varying the amount you spend year in and year out, depending upon as conditions warrant, you can make the money, you can make your money last longer and do better.
The third factor is using annuities in your planning.
Yes, annuities give you the opportunity to gain some additional return by the fact that you're entering into a pool of people who everyone at some point is going to pass away. And what happens with annuities is that a certain percentage of people are going to pass away that are within that pool, meaning that the insurance company now can distribute this money to those who survive. And so it's kind of like getting a free lunch, because as long as the only thing you care about is getting income while you're alive, and you don't care about the fact that you're going to lose income after you pass away, it can be a real benefit. And so by taking at least some of your savings, and instead of putting them all in traditional assets, put some of that in some kind of payout annuity, you can increase your income.
And the fourth one is asset location and withdrawal sourcing.
Yes, this is taking advantage of the system that we have of tax-deferred savings. So here in Canada, we have RRSPs, which investors should be taking full advantage of during their working years, because they can accumulate assets in RRSP and not have to pay any tax on them until they reach retirement, in which case, once they're retired, they might be in a lower tax bracket. And the fact is that, over at least long enough periods of time, there's a real advantage of being able to earn income on a tax-deferred basis than having to pay tax year in and year out. So by taking advantage of that system, you can improve your retirement income. And then also, once you retire, you want to do what we call the withdrawal sequencing, which for most people would mean taking the money out of your taxable account before touching the money in your tax-deferred account, because the longer it sits in that tax-deferred account, the better tax advantage it's going to get.
And finally, the last factor is something you call liability relative optimization.
Yeah, here the idea is that when I'm managing my assets, I should do so in view of what are my liabilities. And for a person who's retired, those liabilities are, all the spending that they're planning on doing when they're retired. And what's the primary risk of what's going to change the value of that spending? A lot of that is going to be related to inflation, particularly unanticipated inflation. And so that means when you're doing your asset allocation over on the asset side, you want to pick assets that are going to be particularly sensitive to inflation, such as inflation-linked bonds rather than ordinary bonds.
Thank you very much, Paul. And once again, Paul's co-author on this paper, David Blanchette, who's head of retirement research for our Morningstar Investment Management Division, will be speaking on this topic at Morningstar Canada's Investment Conference on June 5th here in Toronto.